Hello. You probably have been trading trendline strategy the wrong way, and in this video, you will learn how to trade trendline as a system so that you reduce your losses. And for this video, we're going to be going through this highlight: what are trendline, why you cannot trust trendline alone, moving average, the dynamic trendline, liquidity and breakup structure, necessity check, and putting it all together. So first of all, what is trendline? In simple term, trend line is this diagonal line, this straight diagonal line. That's a trend line, and a trend line is when you use a line to connect past market to current market diagonally. That's simply what trend line is. There's no fancy to it. So this scenario, this is a scenario starting from the 23rd of December until the 6th of January. I decided to use a recent example. This is a trend line. Now, how do you know a trend line? You know a trend line if the trend line is able to touch at least two tops. They call it two tops or top. If you draw a diagonal line in the market and the diagonal line is able to touch two market top or market lows diagonally, then that is your trend line. As we see here, this trend line, take this out. This trend line starts from here, 24th of December, and it touched. This is the first touch here, and then this is the second touch. So as long as it's able to touch two diagonally placed price movement, then I can draw it. Let me show this to you. Let me take out this trend line. So starting from here, this is the first point. As long as I can draw this trend line and it can touch this trend line in a diagonal shape, then I can now draw it down so that in the future, when market is trading up and it touches that line, then I would know that this is a line that been drawn. This is a line that connects the past market to the current market. Come on. So that is a trend line. It can extend downwards even more. So why can't you trust trend line alone? Why can't you trust trend line alone? Personally, in my own opinion, you can't trust trend line alone, but I know a lot of people that use trend line as their standalone strategy. But you can't trust trend line alone because sometimes you will have to decide if you want to capture just the full body or if you want to capture just the wick with your trend line. For example, if you see this trend line here, this is a perfect diagonal line, but we see that even though we capture this second touching, there were some wicks that actually went above the trend line, and it happened here and it happened here. You see the wicks went above the trend line, but then you come to this spot here and you notice that price did not even get to the trend line. Give me a second. You come to this place, that's the 30th. That's the 30th of December, and you notice that price did not even get to touch the trend line before it made a reversal. And you come up here and you see that price perfectly touched the trend line and it went back here. So it's not like you can't trust trend line. I mean, it works for a lot of people, but using trend line alone, there are a lot of conditions that you have to break, and there are a lot of rules you have to break to use trend line. So you can't really use trend line alone because of that, because of what I just explained. Because sometimes you have to decide, do you want to catch the full body, do you want to catch the wick, or you don't mind the wick going out of of the trend line and coming back, or as it happened here, does price have to reach the trend line before you take that trade? So that is why you cannot trust trend line alone. Now the moving average as the dynamic trend line. If you have traded forex before, you know that the moving average is a very popular indicator. It moves with the trend. As you can see, I have two moving average on my screen. This is the 20 exponential moving average, and this is the 200 exponential moving average. The reason why I wanted to talk about moving average in this video also is because moving average is a dynamic trend line. Sure, it doesn't move the way the normal trend line move, because the manual trend line you are drawing it to catch perfect situation or almost perfect situation. Take for example this 200 moving average. Let's start from the 21st. It taps here, it goes on this dangly line. It captures here, also captures this point, which is the second touching. Let's say this is the first touching. Then it captures here, which is the second bottom is capturing. So as long as it touches here, then we can call it our trend line. We can call it our dynamic trend line. Now market came back here, it didn't touch it, but market went back up. Market then came back down to this trend line, it touches it, and then it went back up. At this point it is serving as a dynamic trend line. And then before market broke through the trend line, and as soon as market broke through the trend line, then you can see that market went into a downtrend. Market went into a downtrend as soon as it broke through the 200 exponential moving average trend line. And once market broke here, you see that market went back up, bounced off the 200 EMA. It went back again, it crossed the 200 EMA, but it bounced off the manual trend line that we just drew here. It came back up, bounced. I think I should remove this 20 EMA. Should remove this 20 EMA. Yeah, so market came back here again, bounced off the 200 EMA and the trend line, came back here, bounced off. So you see that it's moving as it's serving the 200 EMA can also serve as your dynamic trend line. So one advice I would give in this video is, if you're using trend line strategy, you should also use the 200 EMA as one of your supporting dynamic trend lines, so that you can use both of them together, as you can see from this video. So the next thing we're going to talk about is the liquidity and break of structure necessity check. Now trend line, most people using trend line strategy because they think it's as well. I mean, it could be as easy as just taking the trade as soon as market hit the trend line, but just so that you can be consistent with trend line and the market, it is better to turn the trend line strategy into a system, so that you know that this is the system you're following. You're not just waiting for, I mean, this looks good. If you see this trend line looks good. I say it looks good because after this two touch, once market got to this line, if you took a trade here, you'll be in profit. If you took a trade here, you'll be in profit. If you took a trade here, even though market did not touch this line, you'll be in profit. If you took a trade here, you'll be in profit. So if you had just traded it like that, that's good. But that does not happen every time. Sometimes market comes to this trend line, trades above this trend line, and then dumps itself back into the market. So you have to actually have a system, and that is where liquidity and break of structure comes into play. We're going to start, so we're going to use here as when we start using the trend line, because before we can call this a trend line, we must make sure that it has touched 2 points in the market diagonally. So which is, this is the first point and this is the second point. So after this point in the market, since this is the second point in the market is touching, it is officially a trend line. So that's why I was starting with this one, with this point in the market. So liquidity is just an area in the market where price is hoarded, or where there's going to be a lot of price action. Now this price action can be liquidity, can be stop loss hunt or stop loss sweep, and the areas of liquidity in the market are usually demand zone, supply zone, equal high or relative equal high, or relative equal high and lows in the market. And also liquidity can also be the highest or lowest points of the current day market, or the highest point in a particular trading session, whether Asian session or New York session. So that's liquidity. Just to give you an example of liquidity, yeah? When we talk about demand zone, demand zone and supply zone, which pretty much mean the same thing, but difference comes when you're talking about buying or selling. When a particular point in the market starts the movements to break structure, then that is a demand zone. For example, just want to do a very fast explanation. I'll explain this extensively in another video, but just for the sake of this trend line strategy. So I put this horizontal line here because from this point in the market rallied, and it closed above this previous high. So this is a current high. I'm writing text here. I'm going to write number 1 as our previous high there. Is that even visible? Okay, yeah. That is the first high. That's the previous high. The market came down. Then from this point, market rallied up and broke and closed above this previous high. So I'm going to write number 2 there, so you know that is our next high. So the reason why I'm giving this illustration is so that you know that this particular point in the market that started the rallying, that started these movements that broke this first high, this particular point here will be called the demand. This particular point here will be called the demand. It can also be called an order block. It can also be called another block also. And surely it is a liquidity zone. And surely is a liquidity zone. Liquidity, come on. Excuse me. And surely that's a liquidity zone. So demand and supply zone are any zones that rallies to the point of breaking a previous high or previous low. So this is a liquidity zone. So at this point here, there is liquidity. At this point here, there is liquidity. And I'm going in the point of supply. For the point of supply, we can see that from this particular zone here, market went down. It didn't completely break this zone. This zone wasn't broken properly, but this zone was broken. So this is our supply zone. So this would be a supply zone. This would be a supply zone, and also a liquidity zone, because Every supply zone is liquidity. Every supply zone is liquidity. So demand and supply zone are zones where are zones that start the break of structure in the market. So I think I'm trying to put a definition together that explains both liquidity and break of structure. Now liquidity is where there are going to be so much price action in the market, and the zones of liquidity are demand zone, supply zones, equal high. Equal high is just simply like these two, this number one and number two. You can call them relative highs, but as long as they are around the same point in the market, they can be highs. You can call these points and these points relative low. If they are equal, then you can call them equal low. Anytime they are equal lows in the market, then surely there's liquidity there, because so many people put their stop loss there, so many people put their orders there. So that's why there is liquidity there. So just summarizing the definition of demand and supply, transitioning into breakup structure. Demand and supply is where the breakup structure started from, and breakup structure is just when a previous high and previous low is being taken out. For example, number one here is our previous high. Market went down and then came back up and closed above number one, which is our previous high. So therefore, this is a breakup structure because because a higher high has been created. So I think the best word was higher high. So anytime a higher high is created, this is a high. Market went down, broke the high. This became the next higher high. So this is a breakup structure. Market came down again and broke this previous high to lead here. This is a higher high. The same goes for low. Anytime there's a higher high being created, or a previous high is being broken, or a previous low is being broken to create a lower low, then that's the breakup structure. If you have any question, please do not hesitate to put it on the comment section. So now, putting it all together, how do you add liquidity and breakup structure necessity check to your trend line strategy? First of all, you have to get your trend line, and your trend line has to touch 2 points in the market diagonally before you consider it a legit trend line. And then you can also use your moving average as your dynamic trend line. So you probably can choose one. It is better to use both of them together. As you can see in this zone here, market escaped the moving average, but it got caught by the trend line. So anytime market goes back, remember we're using, let me take this out. Anytime market goes back into the trend line, you must wait for liquidity. You must wait for liquidity to be swept, one, and two, you must wait for a breakup structure to occur. These are the two things you have to wait for: liquidity to be swept, breakup structure, and then it retests the market. So let's use here as example. Market went back up here. Has liquidity been swept? Surely liquidity has been swept here. Now let me write. Let me see. Remember I said earlier on that liquidity is on any supply zone. Liquidity swept. Forgive my typing. So liquidity has been swept. Liquidity is staying at this point in the market. I think it's better I use a line to describe it. There is liquidity above this point in the market. Why? Because that is a supply zone, Remember it was said earlier on that a supply zone is the start of, is an order block that lead into the breakup structure. Now if you notice from here, price went down and it broke. This is a low in the market, this is a low in the market, so price went down and it created a lower low. So that is our supply zone, so therefore there is liquidity staying there. So market went back up here and it touched our trend line. So what are we going to look for when you touch our trend line? We're going to look for, is there a liquidity sweep? And yes, there was a liquidity sweep here, because this supply zone has been taken out, has been liquidated. Now there might be even more price action. This price action here looks simple. There might be even more price action, but as long as price has taken out this liquidity, then that's one of your criteria being fulfilled. So after price take out this liquidity, then there must be a breaking structure before you take this trade. And a breaking structure is a lower low must be taken out. Yeah, for this, there are more ways you can identify a breaking structure, but for the sake of this tutorial, to make it simple, a lower low must be taken out, or a high high must be taken out before you consider something a breakup structure. So after market went up to this moving average, market broke, and then market created a lower low here. This was a new lower low because this was the previous low that market just took out. So after market took liquidity, it went down, it could not break any. See, notice that once market went down, there was no breaking structure. It went back up, and then the breaking structure occurred after it broke and it closed below all of these lows here. So when it closed here, that is now a breaking structure. Then market went back up, and then you can take your trade. You can trade once there's a breaking structure, then you can take your trade at the close of any FEG. And seeing that this is a short scenario, you would have taken your trade here, and you put your stop loss at the first point that touched the market, and then you can target probably 1:2 or 1:1.5, and that would have been a good trade. So that's just how to trade trend line. Once market goes back into your trend line, you first of all wait and check that a liquidity have been swept. Your liquidity zone can be a supply zone, a demand zone, or a place of equal highs or relative highs, or equal low and relative low. After liquidity is being swept, okay, I think this is the best way to write it. Let's see, liquidity swept here. Liquidity swept here, and then here was the breakup structure. Breakup structure here. Breakup structure here. Breakup structure occurred here. So after the breakup structure occurred, then you can wait for price to go back into and close this space here, which is the FEG. And once price goes there, you can then take your sell, and that is the best way to use. That's the best way to turn your trend line strategy into a system, by using liquidity of the market and by waiting for a breakup structure and then a retest at the FEG, and then you take your trade. As you can see, the same happened here. Market went back, market came back up to the trend line, it took out liquidity here, and you wait for a breakup structure that occurred here. occurred here. Breakout structure occurred here, and you would have taken your trade here, or you'd have waited for market to go back up as it did here and close the FVG. You'd have taken, that would have been another trade to take here, and you put your stop loss above the points that touch the market, which will be here. That's 20 pips, and then you can target 1:2 or 1:2. You can see market went way down. I share insight like this on my Telegram group, and the description and the link will be dropped at the description in the comment section. So just if you have any question, you can come and join us there and ask any of your questions. You can leave it at the comment and I will make sure to answer it. Thanks.